Fintech Holding, known to many by its US ticker TIGR, operates the popular TIGR Brokers platform, a service that has captured the attention of countless retail traders, particularly within the global Chinese diaspora. The company offers a suite of services centered around trading, data analytics, and wealth management, positioning itself as a modern gateway to the financial markets. As of today, February 9th, 2026, the stock presents a fascinating puzzle, trading at a price that gives it a price-to-earnings ratio under 10. While its revenue growth has been impressive, a dark cloud of regulatory uncertainty looms large, causing many investors to hesitate. This essay will thoroughly investigate the core question: is TIGR a deeply misunderstood and undervalued fintech gem, or is it a classic value trap poised to ensnare unwary investors? This analysis is not merely a surface-level glance at the numbers. We will peel back the layers of the company's financial performance, competitive landscape, and geopolitical vulnerabilities. The stock's price has been notably volatile, swinging on news headlines and shifting market sentiment far more than on its own quarterly reports. Understanding the fundamental business is therefore critical to cutting through the noise. We will examine the trends in both revenue and profitability to build a clear picture of its operational health. We must also place its valuation in the proper context by comparing it to its peers and its own historical levels to determine if the current low multiple is justified or an anomaly. Before we proceed, a necessary disclaimer is in order. This essay is crafted for educational and entertainment purposes only and should not be construed as financial advice. The world of investing carries inherent risks, and the specific circumstances surrounding TIGR involve a complex interplay of market forces, technological competition, and significant regulatory pressures. Every investor must conduct their own thorough research and consider their individual financial situation and risk tolerance before making any investment decisions. The goal here is to provide a comprehensive framework for thinking about this particular stock, not to issue a directive to buy or sell. The central conflict for any potential TIGR investor is weighing its undeniable growth against its significant, well-documented risks. The company has successfully expanded its user base and continues to roll out new products, which are positive indicators of a dynamic and responsive business. However, the regulatory environment for Chinese technology and financial services companies remains a primary source of concern, capable of altering the company's prospects overnight. By dissecting each of these elements, the growth, the valuation, the risks, and the potential catalysts, we can arrive at a more balanced and informed perspective on whether TIGR represents a genuine opportunity or a dangerous pitfall for your portfolio. One of the most compelling aspects of the TIGR investment case is its impressive revenue growth over the past several years. When you look at the simple numbers, the trend is clear and positive. The company reports its trailing 12 months revenue. This figure has consistently climbed year over year, signaling a business with strong forward momentum. For instance, revenue grew from about 135 million to over 260 million and has continued to build from there. Today, TIGR trades at a trailing price-to-earnings ratio that is remarkably low, sitting below 10. In the world of technology and financial services, where growth companies often command multiples of 30, 40, or even higher, such a low figure immediately catches the eye. A low PE ratio can be interpreted in two fundamentally different ways. On one hand, it can be a glaring sign that the stock is deeply undervalued. On the other, it can serve as a stark warning that investors anticipate significant future trouble, such as declining earnings, increased competition, or a catastrophic regulatory event. To gain perspective, it is crucial to compare TIGR's valuation to that of its peers. Here's a simple comparison. Charles Schwab, Interactive Brokers. TIGR's PE ratio appears exceptionally low, as these more mature companies often trade at PE ratios in the 15 to 25 range. Even when compared to other high-growth fintech players, TIGR's multiple seems compressed. This simple comparison suggests that, on a relative basis, the stock is cheap. However, this comparison is only valid if the risks are comparable. The market is clearly applying a significant discount to TIGR, largely due to its regulatory exposure, which its US-based peers do not share. A PE ratio, while useful, is a static snapshot that does not tell the full story. It is more powerful when considered in the context of earnings growth. This is where analysts' earnings per share estimates become valuable. Current projections suggest that TIGR's EPS is expected to grow in the coming years, though the range of these estimates is wide, reflecting the uncertainty surrounding the business. If the company can successfully execute its strategy and achieve the higher end of these EPS growth projections, then its current low PE ratio would indeed look like a bargain in retrospect. The stock would experience a re-rating as the market gains confidence in its earnings power. Conversely, the stock could be a quintessential value trap. If earnings growth fails to materialize, or worse, if earnings decline due to regulatory pressures or intensifying competition, then today's low PE ratio will have been a false signal. A stock with a PE of 9 is not cheap if its earnings are about to be cut in half. Therefore, investors must look beyond the simple valuation metric and focus on the company's ability to defend its margins, maintain its user growth, and navigate the complex regulatory landscape. The single most significant factor weighing on TIGR's stock price and compressing its valuation multiple is regulatory risk. This is the main overhang no bullish narrative can ignore. TIGR has deep operational ties to China and serves many users in the mainland and diaspora. Beijing has launched a sweeping, unpredictable campaign to tighten control over tech and finance. New rules can arrive swiftly, with little warning. They can fundamentally alter the business landscape. Regulators could limit or even prohibit TIGR's services. They could crack down on cross-border data flows. They could restrict mainland citizens from opening new offshore accounts. They could block adding funds to existing accounts. They could constrain marketing activities. They could cap fees and interest rates. The market's fear comes from precedent. Think private education crackdown. Think video gaming crackdown. Online brokerages could be targeted next. A negative pronouncement from PBOC or CSRC could send the stock tumbling. That uncertainty deters institutional and retail investors. It creates a worst-case scenario that's hard to model. Until clearer regulation exists, the risk hangs over TIGR like a sword of Damocles. That explains why strong revenue growth still trades at a low earnings multiple. The market is pricing in a potential sudden regulatory shock. Despite the prevailing risks, several potential catalysts could unlock significant value in TIGR's stock and cause it to re-rate to a much higher valuation. The most powerful of these would be continued strong financial performance, sustained revenue growth. In conclusion, UP Fintech Holding presents a classic high-risk, high-reward investment scenario. It is a company with two distinct and conflicting narratives. On one hand, the GEM thesis is supported by undeniable evidence of strong, consistent revenue growth, successful international expansion into key markets like Singapore, a technologically advanced platform that resonates with a new generation of traders. This is all available at a remarkably low P/E ratio under 10, a valuation that seems disconnected from its growth profile. These factors point toward a company that is deeply misunderstood and potentially significantly undervalued by a market overly focused on a single risk factor. On the other hand, the value trap argument centers on the massive, unquantifiable regulatory overhang. The risk that Chinese authorities could cripple its business model is real and has been the primary reason for the stock's depressed valuation. Beyond this headline risk, the company faces fierce competition that could erode margins, a cyclical dependence on market trading volumes, and significant execution risk in its global expansion. If any of these risks materialize, if regulation tightens, competition intensifies, or expansion falters, the company's earnings could decline, making today's low P/E ratio look expensive in hindsight. The stock could remain trapped at low levels or fall even further. The most balanced verdict is that TIGR is a speculative opportunity with a clear, identifiable path to a much higher valuation, but one that is fraught with peril. It is not a safe, conservative investment. For investors with a high tolerance for risk and a long-term time horizon, the potential reward may justify the risks. The key is whether the company can continue to successfully de-risk its business by growing its international footprint faster than regulatory threats can materialize. If it can achieve this while moving towards sustained profitability, the stock could experience a dramatic re-rating. For those considering an investment, a cautious and disciplined approach is paramount. The 42 macro entry strategy offers a simple framework. Consider building a position in 4 equal parts, buying the first 2 tranches at current levels, and waiting for at least 2 consecutive positive quarterly earnings reports, and greater regulatory clarity before deploying the final 2. This phased approach mitigates timing risk and allows an investor to confirm that the positive fundamental trends are intact before committing full capital. Ultimately, TIGR is a bet that its impressive growth and global diversification will eventually outweigh the market's legitimate fears. Share your analysis in the comments. Where do you land on gem versus value trap? Disclaimer: this video is for educational and entertainment purposes only and does not constitute financial advice. Always do your own research.